Let's get a round of applause for the whole team. Rachel, Zachary, Raha. This is hard to do. It's very hard to keep this up. This is, how many years is this? 10? Yeah, it's like a restaurant. They're hard to keep hot. Like, you guys do a great job. Okay, we're going to dive in. So, the title of this panel, gentlemen, the title of this panel kind of implies very strongly that VC needs to be reassessed. And you're on this panel, so I'm assuming you agree with that in some form or another. So let me start with that. Why does it need to be reassessed? What's broken? What's fractured? And then we'll get into what changes have to happen. So let's start with Lorin.
I mean, I think it's a fairly uncontroversial statement that venture at the moment has a problem, and I think that problem very clearly is DPI. You know, funds are stuck.
I have a no acronym rule on my panel, sorry.
Right, sorry. Essentially capital distributed to investors and LPs. So VCs are sitting on portfolios with massive paper markups, but there is no exit market currently. That's because the IPO markets have been closed and are broken for quite some time. You can see the same thing on the M&A piece, and you know, we can talk forever about the structural reasons underpinning that, but I do think that VCs have, I think, a broader underlying issue, and that is fundamentally, and it's kind of ironic because as VCs we like to preach innovation and drive that. But if you look at the way that VCs work, that model hasn't really changed, I would say, in the last 20 to 30 years. This 2-20, 10-year model with sort of, you know, a seed focus, Series A, Series B, that type of sort of approach. I think that model is stuck, and I think we need to critically reassess that for us in the industry. Okay.
Simon?
Yeah, well, I think that you were talking, Lorin, about the markup, but the reality is that the main reason for the motivation for changing the model is actually the massive write-off that we've seen in the last 2 years. I mean, just in the US, there was a 1.5 trillion write-off of value on the venture capital portfolio, which in a sense has been impacting the whole chain of value, including the LPs themselves. They couldn't even serve the 7% that they generally serve. So that's a massive impact. And
Simon, does that valuation write-off, does that come from a bad prior valuation, or is it a function of liquidity that Simon's talking, that Lorin's talking about?
Directly connect to the market, the paper market that Lorin was talking about, which was only in the paper. And one of the key rules in VC is actually you should only write the value of the markup only when you get your DPI, when you get your money back. And that's something which has been forgotten. And I think that on top of that, in terms of the model, the metrics are today completely disconnected to the reality. So there's a need for a change, there's a need for more responsibility, there's also to understand or to agree again what's VC is for. And I think I mentioned now, proposal call, yes.
We'll get into solutions in a second. Joe, Millennia, not to be confused, Millennia,
Yeah.
New York City based, right?
Yeah.
Wait, Lorin, where are you?
London.
Say again?
London.
London, Simon? London, New York, and Greenwich.
New York.
Well, New York, yeah. So Joe, what's broken?
Well, VC is sort of like the new kid on the block. So you got private equity, credit, real estate being around for decades, almost a century. Venture is really kind of the child in the room. We're growing up. And so there's sort of, as we're growing as an industry, we're realizing, you know, performance versus sizing. You're seeing a lot of the venture funds like Lightspeed becoming an RIA, equivalent to like an asset manager or a wealth management firm. But venture, you don't need that much capital to invest in the companies. Like in infrastructure, you need $1 billion to do a project. But in venture, you can give a founder $1 million. So by definition, venture would be a smaller industry because it's the equilibrium of the supply and demand of capital. And so we're struggling in kind of figuring out which direction to go, performance versus sizing.
Got it. So where do the investors want you to be?
Well, the investors want performance.
Okay.
And I think, and there's sort of a kind of two incentives. One is when you run a bigger fund, you have more fees, you can hire more, do more things.
Right.
But at the same time, when you become a bigger fund and you don't need to cut that big of a check to support the companies, you can sort of give too much capital and spoil those companies.
Yeah. Okay. So David, Joe's saying that VC is the new kid in the block and they're not in sync with their investors. Did anybody get that? Come on. New kid in the block, in sync.
Very funny.
Wasted.
Excellent.
David.
Yeah. So here's just, so venture's been around 55, 60 years or so as a sort of tech-focused originally, but now broadly, but I agree it's small compared to everything else. But just a couple numbers. So about 6,000 venture capital firms have invested in currently about 58,000 companies right now. This is mostly focused on tech. You could define venture a little more broadly, but tech, healthcare. So venture does a good job of doing some value creation, but the median returns in venture are abysmal. So you only want to invest in venture capital if you're investing in the top quartile of those 6,000 managers. And with 58,000 companies, how do you get liquidity, as was mentioned? So we only do in the US about 180 or 200 IPOs a year and about 1,000 tech M&A outcomes a year.
Does that include SPACs?
Not including SPACs. SPACs, you'd add like 800 more 2 years ago, but non-SPAC IPOs had about 200 a year. So, it would take like 47 years for all those companies to go public. Now, obviously, they're not going to all go public, but even the 1,500 unicorns today would take 7 or 8 years just to go public, assuming they all can. So I would say like there is a liquidity problem in venture. However, that's true of like traditional tech venture capital. In crypto venture capital, we don't have this liquidity problem because we've created a new way to get companies liquid, and that's that we tokenize their assets and that we list those on exchanges or decentralized exchanges, and we can achieve both liquidity and DPI for investors much earlier.
Okay. Lorin, you're not in crypto.
Actually, I am.
You are?
Yeah.
Oh, sorry, apologies. But not 100%. You're not, are you a crypto-focused fund?
I mean, we do a lot of different things, but we do have a bit of a crypto focus. And
So you buy into this tokenization argument as a resolution for this duration liquidity issue?
100%, because I wanted to pick up David's point here, is that, to my prior point, like IPO markets are, I think, fundamentally broken. And one of the main innovations that you see in crypto right now is indeed there's immediate liquidity. There's a lot of liquidity going there. And we're doubling down on that thesis because we historically have been company builders just as well as investors. And what we're trying to do is we're taking fundamental business models that are not working in traditional markets, like biotech, for example. Biotech markets have been structurally broken since 2022, since the main downturn, and seeing how we can marry that up with sort of a crypto universe. And my strong personal conviction is you're going to see this like almost parallel sort of market system develop that I think will eventually surpass the traditional system because it's so much more efficient. Okay. So we're very bullish on that thesis as well.
Simon.
Yes, so I think we have to, yes, I'm also in crypto, but on the side of my digital bank, so not on the VC file. Okay. But I think that we have to look at two ways. First way should be a return to fundamentals. Today, most VC is not VC, is tech private equity. And how we see that, you see, first of all, that although most of the investors are minority investors, they are actually taking control of the board by a very long list of covenants. Mm-hmm. The second thing is that the LPs have been promised a cycle of 3 to 5 years for liquidity, when the reality, when you do tech, you have to wait most of the time, even for B2C, 7 to 10 years when you see a rate. So there is today a complete desynchronization in between the reality of what is funding innovation and actually what the funds are doing. So that creates this distortion. How it is solved. It is solved by the fact that you create bigger and bigger funds, as Michael was saying, and you sell by secondary to the other fund, but there's never a proper exit. So the first thing is to go back to fundamental VC. You fund innovation. Innovation, even in cycle of AI, takes time. And if you want a company that's going to be able to give you DPI, not by an exit, could be by dividends or revenues, you have to wait time. Then the other side is indeed to create new ways of liquidity, and tokenization is one. Based, as compared to what David was saying, which is right in theory, one of the key issues of tokenization today is that most of the exchanges don't have enough liquidity to support the kind of exits that you would want. Most of the exits need still institutional investor to bring in liquidity and do. But
let me play devil's advocate, and Joe, you can, Simon, but also Joe, and then I want to get back to David on tokenization. So, but as an investor, as an LP, why do I care if it's secondary market liquidity, if it's primary market liquidity, if it's your brother buying it? Why do I care? As long as I get my return.
No, it's very different. Means if it's secondary market liquidity, it means yes, you're going to get the money at some stage if you're lucky. Like for example, early stage or late early stage. So when we sell, yeah, look, secondary is good for us. The problem is that at the end, it looks like a bit as a Ponzi scheme, because at the end, somebody is going to pay the bill. And if you don't have a primary market liquidity, then you get stuck. And this is what happened, 1.5 trillion of write-off in 2 years just in the US. So you need to solve this liquidity problem, because then the whole industry is impacted.
So Joe, how do we solve this?
I'll just give like a one-liner on what we do. So 4 years old venture firm in New York. We're now at about 300 mil US, 20 investments, 20 plus investments.
First fund? How many funds?
Second fund now.
Second fund.
Our largest investments are OpenAI, Scale AI, Grok, the chips company, Lambda, Stability here in London. And we're like heavily AI now. We also have like e-commerce and fintech investments. So the way we're structured is when we exit, we distribute shares back to our LPs, asset management firms, RAs, families, individuals. That's
baked in. The in-kind distribution is baked into your documents.
So, and what that means is our LPs want the shares of OpenAI and Anthropic because they believe that if and when OpenAI goes IPO in, let's say, 2 to whatever years, that the shares have a lot of room to appreciate in the next 10 to 20 years.
And do you value them at the time of transfer independently?
Correct. We do. Okay. So that is why for us, like, we offer liquidity to all of our LPs, but almost nobody yet wants to sell because they're like, we are investing with you because we want those assets with us for the next 20 years. So that's kind of point one. Point two is, and the point I was trying to make is, so some venture funds will sell assets in the secondary market, but they're distributing them cash. And when you send out cash, you have to pay taxes. But when you distribute shares and the LPs don't sell those shares, they get the shares back in their brokerage and they can take out a loan against it. It's actually much more tax efficient.
How good is that? How liquid is that lending market right now?
Pretty liquid.
Yeah.
Like we could sell our stake, our LP units in Anthropic like tomorrow if we wanted to, but we
okay, but that's for Anthropic. I mean, so how like does it? I mean, is it 20 companies then it drops off a cliff or like how?
Correct. Okay. So I think something else that's broken in venture, and I'm realizing now, I'm doing more and more of this is. Like, can I use a sports analogy? Like in every venture ecosystem.
It's mostly guys here, unfortunately. So
in every venture ecosystem, there's only a set of the best companies that will make it for the next 10 to 20 years.
Okay.
It's kind of like a draft class of a football or soccer or the NBA. Only certain players, only the top 10 might make it to the IPO stage. And so what we got to do now in venture is I think we're diversifying too much. I think we gotta have conviction and concentrate on the leading companies and really pick companies that we think are going to be around for 10 to 20 years.
So David, I'm sensing a lot of pessimism that the traditional IPO market, let's say in the U.S. as a leader, is going to ever return. Normally these things are cyclical, so it seems like, do you agree with that pessimism?
I think so, because the costs of being a public company and adhering to U.S. regulation, the new SEC chairs talked maybe about trying to rid some of that cost, but look, the markets have not been receptive to look, in the 80s and 90s, what drove venture capital returns was companies going public on 60 or 80 million in revenue. Now it's 400, 800, $1 billion in revenue, and still growing 30% a year. It's very hard of those 58,000 companies to find ones that at $1 billion in revenue are still growing 30, 40% a year. So what we've done, though, is we've deprived retail investors and even many institutional investors of participating in the high growth stages of many of our most exciting companies. I agree that maybe only 10 or 20 turn into the Apples and the Microsofts of the world. But of that 58,000, there are still thousands of companies building billions of dollars of enterprise value that no one else gets to participate in unless that company goes public. So what I think is broken with capital markets is that we just let too few people participate. Now, I'm not saying that all grandmas should be investing in venture capital, but I am saying that the gatekeepers have restricted too much capital, even institutional capital, to get into a lot of high-growth tech companies. And in my view, the best solution to that is, in the 90s, we digitized turned the internet on, and we let anyone be a publisher and anyone read and participate in media. Now, that's had some positives and a whole lot of negatives. But we can do the same thing with capital markets, and that's what crypto allows. Anyone connected to the internet can participate in the financialization of companies.
So David, how do you respond to the fact that, or to the claim or the argument that if you massively decrease the friction associated with public listing, you by definition will have a garbage in, garbage out problem. You'll be flooded with the equivalent of meme coins in public markets that are facing retail? Like how do you manage around that?
I don't think it's zero. I don't think you say there's no regulation. But look, I mean...
Oh, no, not regulation. There's the cost and the friction, right?
Well, I mean, I think the market, you need a willing buyer, willing seller, right? I mean, if you bring garbage to market just because the costs of getting there are low, you still need buyers to support the price. With a problem in mind, I know you're very familiar with the SPAC craze, but you know that has created these weird incentives where the people who bring them to market make money, but all the people who invest in them lose money. Obviously, the markets can self-correct about that. But I guess all I'm saying is I think there are thousands of very interesting technology companies that could participate in liquidity, whether it is the Western public markets. Look, I mean, SpaceX is effectively a public company right now. Like, you get a call every day for their shares, yet they're not traded.
That's true. So, Lorin, let's switch gears for a second. So we think these are maybe ways we'll solve this liquidity crisis, or issue. But where do you, when you talk about your fund, where do you think venture should sit from a risk perspective in a portfolio? So you're talking to a family office or a pension, a medium to long duration investor. Where do you advise that they think about you?
I mean, I think about it as almost like at a philosophical level, not just in terms of returns. I think we, as humans, as humanity, we almost have like a moral duty to invest in venture. I mean, what is going to drive us forward as a species?
So you tell your OPs, if you don't invest in me, you're a bad person?
Exactly.
That's a great pitch, but I haven't heard that pitch.
You're a horrible person.
That's fantastic.
I'm sure
you have a moral obligation to write me a check.
No, I mean, I think a lot of people in this room undoubtedly have children. Yeah. I have children too. And if I think about the future and sort of the environment my children will grow up in, I think venture innovation has a massive role to play in sort of shaping society as we see it develop. And I think in that sense, I think it's almost a moral duty because, I work a lot with like ultra high net worth family offices and the like, and then you see people like, do you really, is your goal in life just to earn 6 to 8% for the rest of your life? I mean, that might not save us as a species, So I think innovation is fantastic. It that gets me up every day. This is why I'm in this business. So I think we should take more risk, and particularly for fellow Europeans in this room, this is something we should fully embrace. Okay.
Simon?
Well, I think that, first of all, I'd like to comment on what Michael was saying and what David was saying about the size of a market. I think that actually many, many more companies could be exited and generate returns. The elitistic approach and the spray and pray approach of I'm focusing only on the one who are the leaders. First of all, if you know who are the leaders and you have a crystal ball, that means that the game is not fair because it's impossible. The second thing is that the reality is that there is an incentive for a fund manager to focus on raising money rather than focusing on nurturing the portfolio companies. And that's a massive mistake. Because, for example, I'm going to give you an example. In our latest funds, we made 20 investments. We had 8 exits. We had only 3 companies we fell, only two because of the COVID, and the others are still alive. They might not become unicorn, but some of them could actually, but at least that means that we have something like 75% of a portfolio, which is one way or another is going to exceed. That means that you're ensuring the ability to generate more return for your LPs, and that you're also giving more time for the company to get to a point where they're building real innovation. So I invest in deep tech. But
it sounds like to do that, you have to have, like Joe was talking about having very patient investors. His investors are basically infinite duration. Yeah. That's easier said than done. How do you find investors? I mean, are you just selling to sovereign wealth funds?
No,
I mean,
you have to be honest. You have to, I know it's a very bad word. You have to be, I'm so sorry. So in a room full of financiers, I'm very sorry. You have to be honest. You have to tell your LPs that, and you have to communicate constantly that actually real innovation takes time. And if you really want to see results and you don't want to see 80% of your portfolio going down the drain, you have to give us time. So when suddenly you get to 6 years and you start seeing the LPs telling, well, when are we going out? When are we going out? When are you exiting? Can you do a secondary, etc.? That pressure is most of the time negative. But it's true also that it's also in part because of a GP. Why? Because a GP likes to sit on the money, and one of the worst things or most inaccurate things that I hear in the market all the time, oh, we don't find deal flow. I never.
We don't fight deal flow?
We don't find deal flow.
We don't find deal flow.
In 30 years that I've been doing venture capital, not only that, but I've been doing on and off,
Right.
I never had a moment where I didn't have more deal flow than money to invest. In deep tech, which is the most complicated field to find deal flow.
Right.
Can I say one thing about that?
Yeah,
Very
and then
much
Joe.
agree.
Yeah.
So ventures does serve a number of really important purposes, I think, in the ecosystem. Yes, it can fund long duration innovation that won't produce quarterly results, but it also allows for one other thing, and that's non-consensus investing. It's very hard to be non-consensus in the public markets, but in private markets with long duration, you can take bets that the majority of people do not believe in. Last quarter, Q1 of this year, 70% of all VC dollars went into AI companies. So investing in software AI right now is a consensus bet, right? 70% of the market is investing. The other 30% is probably the most interesting from a risk-reward perspective, assuming good VCs and talent. But there are very few asset classes, I think, where you can find the right risk-reward at the right stage for the right amount of capital that can produce what non-consensus investing produces, which is great returns when you're right.
So Joe, you have an interesting model, and you have clearly very special investors that are, I think, the envy of everybody else, right? You have investors who want to sit around for 20 years or plus. How do they think about your risk-reward profile and the concept of their portfolio?
So I'm going to just add on to one of Lorin's point. Lorin's a good friend. That venture does serve a bit more of a social purpose than, for example, buying and selling a stock in the stock market. And that's just my personal view.
Okay.
But when you take a step back and think about investing, like there's two principles I live by. First, you start with macro top-down Fed policy, central bank policy analysis. You're like, so the question to ask is.
And you have an interesting background. You worked as an economist, correct?
Yeah, I was at the Fed in DC. But point being, you have to start to ask yourself the questions: where are we in the economic cycle? And the second question to ask is, what is the outlook for monetary fiscal policy for the next few years? And you have to ask yourself, so right now, like for example, we're in 2025, rates are 4.25, and we think, I just think that the rates are coming down globally because inflation is kind of abated, and central banks have to support.
Over what duration?
In the next 2 years, rates.
2 years? Okay.
Like I give it a 95% chance that the Fed's going to cut rate this year, at least once.
Okay.
Right, not 100%, nothing certain, but. And then you're like, okay, well, when rates come down, asset allocators move assets back to risk assets away from fixed income, and that process takes months and years because CIOs have to reassess. And then from that point on, you have, okay, then we're going to be going to more of a risk-on sentiment in the next few years. So that's point one. Point two, you have to ask, so when I think about constructing a portfolio, I kind of think about kind of assembling a sports team, if you will. Like I would have a good balance of defensive anchors and offensive players and sort of young players. So for example, in our portfolio, we have Databricks and Scale, and I think of them as very defensive players on my roster because they're high growing, they're profitable, they're big, they're going to go IPO in a few years, I hope. And then you have your offensive players that will kind of give you the excitement, that will kind of go for the dunk or the kick or the score, and that include companies like Anthropic and OpenAI. And then on the other side, you also want to have a couple of companies that are your sixth man of the year in basketball, or your young player that will give you that energy boost. And so that for me would be Grok, the chips company. And so we're building sort of an all-weather portfolio. And then the next question to ask is, okay, well, what's next? Like so I think about the economy and the Fed policy like your opponent. If you have your starting roster on a sports team, right? Okay. But you also want to know who you're playing against. Yep. And we're playing against the economy that's growing 1%, 2% real GDP. Rates are coming down. So then I think you want to take on more risk. But if, for example, right now rates are at 0, then I want to kind of actually be much more conservative.
Okay. Okay, so we have 3.5 minutes left. I always like to end panels this way because I think it's an interesting intellectual exercise. I am old enough to remember, at least in the liquid hedge fund side, we used to do, even 10 years ago, we did things that now are considered outrageous. My first hedge fund I worked with crystallized incentive gains quarterly and marked its own book. And that was the norm in New York back then. Now that's just unthinkable. So I want each of you to end, 30 to 45 seconds each. What are we doing today in VC that you think in 10 to 12 years we'll look back and say, how the hell was that the standard? Good question, right? Fair. Yeah, we like it? Yeah, thank you, Anatoly. All right.
I would respond with a more structural comment in the sense that I think we're going to see the era of the super entrepreneur in the next 10 to 15 years. And I think you're going to see a fundamental balance shift of power between entrepreneurs and capital providers. I think capital will matter way less. I think that is, what we're going to see. So I think that's how VCs have to reinvent themselves, by partnering with entrepreneurs early on.
So capital and Ivy League educations are short. Okay, great. Yeah. Simon?
So we talk about the social role of VC. I think that one of the worst things that we're missing out is the lack of social responsibility. When you have write-off in trillions, it's not just trillions, it's actually jobs, it's actually careers, it's dreams, and innovation, which is destroyed. And there's a lot of OPM in the room. When you invest your own money, as an investor, as an entrepreneur, as a VC investor.
OPM, other people's money.
Important.
Right. Okay.
Yes.
So you think there'll be more skin in the game? Is that?
Sorry.
That we'll have more skin in the game?
There must be more skin in the game.
Okay.
The metrics needs to change. There must be potentially a ratio that includes failed investments and not just successful investment.
Okay.
And there needs to be social responsibility on more focus on the companies in the portfolio rather than just spray and hoping that something will happen. Okay,
we have an acolyte of Nassim Taleb. We'll have more skin in the game in 10 years. Joe?
It's crazy. So many of my peers in venture don't do a DCF, this kind of cash flow.
Okay.
Because they just don't know how.
Really?
They just don't. I'm serious. It's crazy.
So you think we'll have more reliance on fundamentals?
That's because venture stage companies don't have cash flows.
But even for growth equities, so many of my friends at billion-dollar funds just don't do a model. And
so kind of a return to basics, like a cycle back?
I think that's what drove 2021 was you're like SaaS multiples are 50 times. Because rates are at 0, but they don't know that. They're saying, well, I'm going to forecast a 50 times multiple in the next 10 years. But what they, so a lot of my peers, and not me, but my peers, my friends, don't.
I mean, Joe, once an economist, always an economist. I understand. You want to go back to fundamentals. You like your spreadsheets. Okay, fair enough. David?
We're reading about how Harvard and Yale are selling private equity on the secondary markets, right? Trying to find liquidity for illiquid fund positions. I think in 10 years, we're not going to have illiquid fund positions. We will be tokenizing the majority, or at least a large minority of private funds, private equity, credit, venture capital, and they'll trade on global blockchains.
Coinbase.
On Coinbase.
Thank you.
They'll trade on Coinbase.
All right, great way to end it. Thanks, guys, so much. Ask them questions afterwards. Thank you.